BP is a favorite for dividend investors. It has a massive dividend of 4.67%. The stock is currently trading at around $35.89 a share, but this stock has been a must buy over the last 3 years. In 2021, at the bottom of the pandemic, it was $15 a share and is now up about 130% from that point. What we're going to be doing today is looking at the stock, comparing it to the market, and then taking it to my automated stock valuation spreadsheet. We'll look at the company's financials, then using the discounted free cash flow model, the comparables company model, and the Ben Graham formula for investing, we'll be giving the stock a fair price and whether or not is a buy or a sell. Let's just quickly have a look at the stock over the last, we'll bring the chart out to the max. You can see back in 2007 it was $140 a share. Times were riding high, and then it was consistently around about $50 to $40 a share, then dropped massively off on the pandemic, and I was saying it's a buy all the way up here. Does the stock still have room to grow? Well, what I want to do actually is I'll compare it to the S&P 500 over that time. Now I will tell you right now, it will not look good in comparison. Yep, 5 years BP is down 13% in that time compared to the S&P 500 being 81. But as I said, it's just because of the pandemic. I want a comparison where you compare the bottom of the pandemic to now, because this is up 130%. And if I was to compare to the S&P in exactly the same time frame, I believe it would be blowing it out the water, where this is up about 90% in that time. And obviously that pays a very nice dividend on top of that. Let's get straight into my stock valuation spreadsheet. So what we do here is we type in the ticker BP, and this will load up all the company data and financials. As said, $35 a share, market cap of 101 billion. A PE ratio of 4.24, that's quite low, we like that. Earnings per share, $8.46. Has a beta of 0.69. That is very nice because it means it's not a very volatile stock, and has 2.9 billion in shares. We'll talk about shares in a minute. The target price, analysts are saying around about $42 a share, so they're at least saying it can grow. Now, one of the key things that people are interested in here is the dividend. Dividend changes based on the price, obviously, but currently it's around about 4.2, 4.6. That's about $1.51 a share, and that means overall they pay around about 4.4 billion in dividend. It is very, very safe based on their free cash flow lows of 17 and 19%. If you want to buy the stock and get paid that dividend, probably the ex-dividend date is around about the 9th of February, so buy before then. Now let's have a look at some of the company's revenue. So we have all the revenues going back from 2009 to 2023. You can see obviously the stock had a lot of revenue back in 2019, 2014, dropped off a little bit, got hit hard in the pandemic, but is back up to those previous levels. So if we look at the stock price, basically on those 2016, 17 levels, if I go to BP and bring this back up, you can see that the stock was currently trading well above where it is currently, up to $40 a share. Next we'll look at the net income. This is the profit, and a similar story again, pretty much all over the place. Got hit hard in the pandemic, but this is actually one of BP's most profitable years, up to 25.6 billion. So that is excellent to see. Next, we want to look at the shares outstanding. Normally, companies buy back their shares. It seems BP was actually issuing some more shares back from 2018 to 2022, but is back down to that number it's been consistently being. So that's good. They've issued more shares. They've raised capital. They've been able to invest. They've been able to pay dividends. They've been able to do what they want. And now they bought back those shares when the stock was undervalued, as we can see back in 2020 to 2023. So that was a great move by them to issue the shares and then buy them back because the stock price was cheaper. Also looking at the assets versus liabilities, you can see it is currently we've got about half in terms of assets to liabilities, $108 billion in assets compared to 205 liabilities. So that is pretty good. And finally, free cash flow. This is where the company can use to pay dividends, to invest. It can also use to grow the company. And the main thing is dividends, and especially in these stock. And we can see that it is down a bit to 22 billion from the prior year, but these last 2 years have been considerably better than all the years before. Right, let's have a look at my discounted free cash flow model. What we do is calculate the future free cash flows, discount them to today's value, and give a fair price. So currently, based on averages, the stock is overvalued, and the price it is calculated as $22 a share. So let's have a look at the numbers here at the top. Firstly, we look at revenue growth rate. Obviously, the growth rate was very big in 2021-22. And down in 2023. So this is actually calculated as 12, which is calculated onwards. But what we'll do here is we'll look at Yahoo Finance and see what analysts are saying in terms of the next couple of years. They're estimating somewhere in the region of 210 and then down again in 2024. So let's put some similar numbers in here. See, these are actually bullish estimates we've got here. So let's bring that down a little bit to 5%. And next, what we want to do is look at the net income margins. Net income margins are quite thin here, but these numbers, I will say more of the 11%. The more recent number is fairer. This brings the stock up to, okay, I don't think that's a little bit on the high side, $123 a share. Let's have a look at this again. And then the net income, the free cash flow net income is on the right side as well. So I don't think this is a fair estimate. Let's look at around about 4.8%, which was the prior year. And this says the stock is a $53 stock. Let's bring down those revenue estimates again. Let's say they're flat over the next few years, $47 a share. So discounted free cash flow model is quite positive on the stock. Next, what we're going to do is look at the comparable company model. This is a way of valuing stock comparing to their competitors. We will look at these particular metrics here: EV to revenue, EV to EBITDA, and EV to PE ratio. Easy for me to say. So let's have a look at some comparable companies. The ones I have decided to pick are Shell, which is a very close competitor in terms of equity value. Next, we'll look at two of the big ones, Exxon, and then also we will look at Chevron, CVX. So what we're looking at here is the revenue, the EBITDA, which is earnings before interest, tax, depreciation, and amortization. And then the metrics here, EV to revenue, EV to EBITDA, and PE, we want lower numbers here. So if we compare them actually using averages of these, based on the other three companies, BP is very undervalued, with the model giving it about a $60 share price, $67 on the high side. So not a million miles away from the discounted free cash flow on the higher side, but it is saying it is a buy. And then finally, what we'll do is the Ben Graham formula for value investing. This is looking at the earnings per share, expected growth rate of a company, and then looking at the bond yields as well. So let's have a look at the expected growth rate of BP over the next 5 years, according to analysts. And they are expecting a negative growth. It's minus 17%. So I'll tell you right now, this will not like BP. So minus 17%. And yep, so that gives a fair value of minus $77 a share. So obviously we will not be taking this into account because of the negative growth rate. But I think the best valuation on this is probably the comparable company model. When you compare it to three direct competitors, all in the similar field, BP does look nicely undervalued compared to the other three companies. Right, guys, thanks for watching. Give a like on the video. Check out my Patreon. Links in the description, and I'll catch you guys next time.